Ladies and gentlemen, good afternoon to everybody, and welcome to this event, which is titled Fueling European Union Growth, Financing and Investing in Infrastructure. Let me just spend a couple of words to introduce the work and leave the floor to the rector of Bocconi University, Professor Tabellini. This event has been organized in collaboration between CAREFIN Bocconi, which is the research center for applied research in finance, and Goldman Sachs International. For this reason, and before leaving the floor to the rector, let me personally thank Massimo Della Ragione and Antonio Gatti of Goldman Sachs for their continuous support in shaping and organizing the format of this event. I must say that the collaboration with Goldman Sachs was absolutely fruitful from the point of view of our university. First of all, because this is the first one, and second, because from the very beginning I shared with Massimo and Antonio the original idea of an event that was focused on the highly debated topic of infrastructure development in Europe and of the new financial solutions that must be envisaged in order to fight against a dramatic credit crunch that is characterizing our markets today. Not only did Massimo and Antonio provide valuable ideas during the preliminary phases of the organization, they also provided constant assistance in setting up the qualified group of panelists that Bocconi is proud to host today. So again, thanks Massimo and thanks Antonio. Just some preliminary remarks before starting the conference. After the welcome address of the rector, I will take the lead of the first session with a brief introductory speech that, in my intention, should sparkle the discussion and provide some inputs for our guest speakers. Then we will have a break, and in the second session, Professor Lanfranco Sen will take the lead and moderate the second session of other panelists, and they will conclude the second part and the conference itself. I truly hope that you will enjoy the conference, and again, my personal warm welcome to Bocconi University. I invite our rector, Professor Guido Tabellini, to join me on the podium to deliver his first welcome address. Thank you, Rector.
Good afternoon and welcome, and thanks to the speakers in particular for being here. We are very glad to host this conference, and we are grateful to the people that devoted their time to organizing it. In particular, let me mention Stefano Gatti and Massimo Della Ragione, so thanks very much for the excellent work. It's clear that investments in infrastructure are an important policy priority everywhere, but in particular in Europe and in Italy now. I'm afraid that this priority is not here always with the best of reasons. Sometimes investments in infrastructure are seen as a way to stimulate aggregate demand at a time of recession, which I don't think would be the best reason, and in fact it could lead to the wrong decisions. The really important reason why infrastructure investment are so key is because they can stimulate the productivity of the supply side of the economy. But of course this means that it cannot be just addressed generically as something done to make the economy more productive, but they have to be evaluated very specifically on a case-by-case basis. And of course, the ultimate test of whether these investments are worthwhile would be whether they are able to attract private capital. And this is not easily done at a time of uncertainty and credit crunch, and this is why this conference is so critical, because the key challenge is precisely to make sure that these infrastructure investments are done also with the contribution of private capital. So thanks for being here, and thanks for organizing it, and I wish you a productive conference.
Thank you, Professor Tabellini. So First session. The first session is chaired by myself and will be introduced with a very, I would say, quick speech that hopefully will sparkle some discussion that will be led by our guest speaker of the first session. So, Mr. Dario Scannapieco, the Vice President of the European Investment Bank, Mr. Peter Oppenheimer, which is Chief Global Equity Strategist at Goldman Sachs, and Bernardo Binismaghi, Business Development Director at Cassa Depositi e Prestiti. I'm sure that they will be able to provide us with their valuable point of view on the topic of the need and importance of the relaunch of infrastructure investment in Europe. In my introductory speech, I want to focus my attention on three main issues. The first one is just a brief outline of the current state of the art of infrastructure needs in the European Union and a quick comparison with what is happening in emerging countries. The second, which is also the core part of my introductory speech, is something related to the massive deleverage process that banks are undergoing in Europe and the need of finding alternative solutions to traditional syndicated loans and project finance loans for infrastructures. And finally, just looking ahead in the future, I will try to answer one question. There is a strong debate in terms of financing instruments as a substitute for loans, but is it only a real problem of finding alternatives for the financing, or does infrastructure development require something that is in addition to financial instruments from the point of view of governments and policymakers? Let's start from point number one. So what is happening in Europe, infrastructure needs, and the comparison with emerging countries? The European Commission estimates that by 2020, Europe will need something between 1.3 trillion and 2 trillion euros of infrastructure investments. Of these figures, about 500 billion to implement the Trans-European Transport Network program, 400 billion plus additional 200 billion for energy distribution, energy transmission network and storage, and 500 billion to upgrade existing power plants and build new ones. Of course, these estimates are probably conservative ones because they do not take into account all the other financial need for other social infrastructures, particularly hospitals, social housing, schools, prisons, and they do not take into account also locally developed projects as well. While these figures are impressive on their own, it is useful to draw some comparisons and parallel with the expected infrastructure spending that is characterizing emerging markets. These countries, as you probably know, are involved in a massive infrastructure program, which is considered a prerequisite to boost macroeconomic growth. And the comparison highlights that from 2008 to 2017, infrastructure spending in China alone is expected to be around $9 trillion. It is 2.7 trillion in India. It is 2 trillion in Russia. It is 1 billion in Brazil. The lower level of public debt over GDP in these countries obviously explain the difference between Europe and the other countries. As you can understand, the comparison is really striking. And probably, as Mr. Oppenheimer will recall later in his presentation, in sharp contrast with what is happening in emerging markets, Europe is now facing severe constraints in terms of additional infrastructure spending. Excessive public deficits and public debts no longer allow government to increase their commitment for strengthening the capital base, and the more pervasive involvement of the private sector becomes absolutely mandatory. And this leads me to the second point of my speech, which is also the core part. The deleverage process taking place in the banking sector and the need to find suitable alternative solutions, both in terms of debt instruments and equity instruments, to bank loans to finance infrastructure. Let's start from the debt instrument. As a direct consequence of a high sovereign risk of peripheral countries in Europe, the banking system has entered in the past few years in a period of massive deleveraging. European banks, even the ones that were highly ranked in the top positions of the league tables, have retreated from traditional activity of project finance lending. This is due to more stringent capitalization rules that have been imposed by the regulator, Basel III, and the European Banking Authority, and the need to reduce the risk of the asset base of the banking system. If we look at the debt instruments in the past few years, syndicated loans have been the most important used source of financing for infrastructure projects, very frequently based on a no-recourse or a limited recourse basis. If we look at the figures from 2007 to 2011, project finance loans accounted for about 5 to 10% of the total syndicated loans market, with an amount that has ranged between $190 billion to $215 billion worldwide. A much lower percentage was represented by funding on the debt capital markets in the form of bonds. In the same period, project bonds, that is bonds that are issued by special purpose vehicles that are involved in projects, bounced between $8.5 billion and $26 billion, with the lowest peak immediately after the demise of Lehman in 2009. Overall, you can understand that the funding on debt capital market is very limited compared to the overall funding that has been provided in the past by banks. And the bottom line is very clear. We must be very realistic during these debates about the potential that we can extract from debt capital markets, because today debt capital market in the form of bond issues is still only a tiny fraction of the overall funding that is available for the financing of projects. However, if this is the drawback, the good news is that there are good reasons to consider bonds as a viable alternative to project finance loans. The first reason is that compared to syndicated loans, bonds are more standardized instruments, and all else being equal, this feature enhances the liquidity of the instrument, provided that the issue size is sufficiently large to generate enough floating securities. Second, project bonds are an attractive instrument for long-term investors and can be issued with maturities that sometimes are longer than the tenors of syndicated loans that are provided by banks. And finally, if it is well structured, a project bond issue can benefit from probably a comparatively lower cost of funding and from less stringent covenants that are required in syndicated loans. These are typically the positive side of the coin that in most of the papers that have been recently issued are frequently recalled as one of the main benefits that project bond can trigger. However, since most of our technicians of this kind of field of finance, we must also be aware of some of the drawbacks. And I have 4 drawbacks, or 4 issues, if you want, to put on the forefront of our attention. The first one is that probably many opinionists do not remember that project bonds are less suitable as a financial instrument than syndicated loans, particularly for projects that are still in the construction phase. Construction phase marks the peak of the risks that projects have during their life. And so, if we issue bonds during construction, very likely there is a certain element of negative effect on ratings. Probably this explains why, in my opinion, project bonds are probably more suitable for projects that have already passed the construction phase, or as refinancing instrument for already existing syndicated loans that banks can give to the project during the construction phase. Using bond after the construction phase is synergistic with bank loans, allowing banks to shorten the maturity of their loans, particularly during this period. And furthermore, once the construction risk is over, bonds can benefit probably from a higher rating because they will be suffering only on the operational risk of the project itself. The second drawback and the second issue is standardization. When talking about bonds, the typical structure of a bond that an institutional investor is familiar with is an instrument that pays coupon during the life and a bullet repayment at the end. In contrast, syndicated loans are tailored to the specific pattern of the cash flow of the project. And if the stream of the cash flows of the project is not sufficiently stable, I find it hard to finance 100% of a certain project only with the use of bonds. So we must be aware of this. The third point is the refinancing risk. Provided that we consider project bonds as suitable instrument for infrastructures, the project will be subject certainly to refinancing risk. If we consider mini-perm structures used during the construction phase, the risk for banks is that the general debt market conditions may worsen between the loan disbursement and the time when bonds are issued for refinancing the loan. On the other hand, if bonds are used only during the operational phase of the infrastructure, and its economic life, the economic life of the project is particularly long, the bond could have a final maturity that is shortened, it is shorter than the life of the project itself, which again triggers a problem of refinancing risk for project sponsors. The fourth issue, probably the most debated, is the rating issue for bonds. The availability of a large investor base for project bonding is contingent on the possibility for the rating to be sufficiently high to attract investors. While recent available evidence from the big three rating agencies demonstrate that project finance is not riskier than traditional asset class, neither in terms of probability of default and recovery rate in case of default, it is undeniable that if the bond does not receive an investment grade rating, it will only attract investors who are specialized in high yield investment, which is certainly a tiny proportion compared to the overall proportion of the market. The importance of rating has been probably the hottest topic, and as Mr. Scannapieco probably will recall in his speech after mine, the 2020 Project Bond Initiative assumes that a sufficiently liquid project bond market can be created in the next 5 to 7 years, provided that bonds receive a minimum rating of A-. I simply want to put your attention on one fact. A recent report by Freshfields, based on a survey of 100 senior investment officers, indicates that a rating of BBB to BBB+ could be sufficient, from their point of view, to attract investors to these financial instruments. So it is not necessarily a question of rating, and it is not necessarily a question of A-. Incidentally, a considerable portion of project bonds that have been rated by the big three between 2006 and 2010 have just received the BBB rating. So probably this is the model class for this kind of instruments. In any case, regarding the minimum level of rating that the bond must possess in order to be sufficiently interesting for investor, the problem is still how we get that desired level of rating. The European Investment Bank has two possible solutions for this. Mr. Scannapieco will be more clear than me in his speech. However, I point at your attention one element. Weak evidence that have been recently published by one of the three rating agencies indicate that the two alternatives have not the same impact. And so it is not only a problem of identifying the possible solution, we must also understand if the effect on the expected probability of default and recovery ratio in case of default are exactly the same for the two instruments. So this is another topic I would like to launch for a possible discussion to the audience. Very quickly, the second alternative, this is on the debt side, very quickly on the equity side. There is a clear signal that investors are growing their attention on the alternative asset class of investing in equity that are representing infrastructures. It is obvious that the typical investors for this asset class are, institutions that search for long-term, inflation-linked kind of investments to match the typical structure of the liability side. And you can name them insurance companies, pension funds, foundations, no-profit foundations, sovereign wealth funds. There are some very raw data on this point. Some of them are pretty much old, but pretty much indicative of the size of the market. OECD estimates that the total commitments of pension funds of infrastructure for 2008 quantify the total stock at $400 billion worldwide. Excluding utilities, this figure, so the possible interest for this kind of asset class, is expected to be around 60 billion worldwide. Towers Watson and Financial Times survey reports that the top 20 infrastructure managers handle around a total of 109 billion, which for 43% is invested in Europe, so around 40 billion. So overall, different figures, different instruments, different alternatives for investments. Coming to the final point, so the conclusions. The bottom line of the data seems to indicate that, unfortunately, the alternative to syndicated loans are far away to be considered sufficiently abundant compared to the massive credit crunch that banks are facing. Our point of view is that developing the market of equity investors interested in infrastructure is probably a promising approach, apart from the fact that probably someone is knocking in order to destroy the infrastructure in Europe. Creating a liquid market for project bond can be an ideal solution probably to complement rather than substitute project loans. However, my point of view is that it is not only a matter of financial instruments. Infrastructure projects are very complex initiatives that characterized not only by risks that are typical of the project, but also trigger risk on the regulatory and institutional setting of every country. Regulatory and administrative risks trigger levels of uncertainty that sometimes go beyond the capability of sponsor to sustain this level of uncertainty. Just to give you an idea, a survey conducted in 2009 by Alan Dovery indicates that what investors require when approaching infrastructure investment is not only public support. Instead, robust rule of law, attractiveness of the regulatory environment, and a successful track record of other closed infrastructure deals are the most often cited factors that drive the choice of a jurisdiction to do infrastructure investments. In our opinion, it is not credible to set up alternative financial instruments unless, as a preliminary and essential prerequisites, government do not reform the fundamental rules of the game to attract private capital. Let me say that what investors really look for, apart from the variety of available financial instruments to invest in infrastructure, are clear regulation, efficient procurement procedures, support for projects in terms of certainty of timing, and a favorable, or at least not discriminatory, fiscal treatment on interest on debt instrument for infrastructure. And let me say very frankly, it is sad to say, but unfortunately our country has not a good record on neither of these elements. But luckily enough, things are improving. I think that frankly, only in this way, Europe will be really able to, just to reckon the title of our event, to fuel macroeconomic growth. Thank you very much. And now I leave the floor to Mr. Darius Cannapieco, the first speaker, Vice President of the European Investment Bank. Just one question to sparkle the discussion to Mr. Cannapieco. Which role that the European Investment Bank is playing for growth strategies in Europe? Thank you very much, Mr. Cannapieco.